Hi, Dominique, and welcome to another edition of the week ahead. Let's kind of dive right into it, but I'm starting to say, as crazy as every week was, it felt like last year, maybe a little bit calmer. Certainly kind of the market's reaction to stuff. Maybe it's just the beginning of the year, but throwing it out there. But first, let's kind of dive into what your thoughts are around the data that came out last week, any of the comments from the Fed officials, and obviously market reaction.
Okay, so we got another string of bad data. Retail sales number in particular was really bad. As a result of that number, the Atlanta Fed nowcast was cut by 60 basis points to now 3.5%. I'd say two things. First, it's still above the trend, so too fast for the Fed. And the other thing is, I did the numbers. It was largely seasonality. If you take the year-on-year control retail sales, which is a really important one, because that's what the BEA uses to compute consumption in the GDP release. Actually, year-on-year, non-seasonally adjusted was the rate of growth was unchanged. And then if you deflated using the CPI for core goods, it's actually, real retail sales have been rising. The growth has been accelerating. So I fear this is another instance of the headline number going against my view. And if you dig into the data a little bit, you realize it's not that negative, but as always, the market is very focused on the headline. So we'll see.
Yeah. I mean, as we've said in the past, we've had these hiccups. I think of like June last year when, everyone was saying Europe, US is entering a recession. Europe's already in a recession. And you were saying, well, I think growth can rebound. And by the way, you were 100% right. The only difference now is central bankers are, well, not the ECB, but the Fed, it seems to be kind of stepping down. Also, they're at a much higher rate than they were 7 months ago anyway. So that's obviously, that has to have some impact in general. And then were you surprised by any of the Fed comments, Fed reactions to the data?
Yeah, I was a bit surprised by Waller because I thought he'd go for 50 basis points. And he went for 25 basis points instead. And to me, the big picture remains that we have unemployment at a 50-year low and the real Fed funds rate negative between 1 or 2%, depending on which measure of consumer inflation you use. And so to me, if I was a chat bot, if I was a chat GPT, and I had not been trained on the macro data of the past 30 years, I would spew a monetary policy prescription saying you need to hike until you get to a positive real rate. But obviously, I'm not a robot. Whether that's good or bad, I'm not sure. And I think what is going on is that our FOMC members are on the wires, do the rounds in the talk shows, think tanks, and they get asked questions by people who are very focused on the latest developments, the latest print, which makes sense because those people are investors, they have to report their P&L, monthly if they are lucky, but they still have to mark daily and so on and so forth. So people who have a much shorter time frame and not as broad in terms of macroeconomic analysis. So FOMC members under being driven or be expressing views about the latest data point, which in my view is only going to add to market volatility. I mean, compare our FOMC member and the SNB president, Thomas Jordan. He never speaks. or he speaks a few times a year. I mean, this is one extreme, but the problem with talking to market participants is that you are always going to convey more certainty than you should, because in front of you, you have people who want to analyze, and I'm one of them, by the way. By the way, you're every word and are going to throw, factoid at you, and it's very hard to recast the conversation at a level which is conveying what you know and also conveying the way you think about the economy. So I fear, I just have to be patient. If my view is correct, the data will turn and the Fed will turn. But I don't think this will happen for a few months. Meanwhile, we'll have a fantastic environment for risk, because, we'll have even the hawks, saying, oh, we have to see what happens with the data. And yesterday, Vice Chair Brainerd was basically claiming victory, said that the Fed had managed to lower inflation, and their biggest achievement was keeping inflation expectations anchored. I mean, of course, she's, a skillful speaker, so she injected just the right quantity of doubt. But for now, there is no question that the doves are supported by the data, the short-term data, and so
but she's still saying it should be restrictive. The policy should continue to be restrictive, right?
Oh, definitely. But I think right now the consensus among doves and hawks is SCP, so going to 5.1% as terminal rate. The question is, what do you do once you get there? And there is a good chance that you'll be there mid of Q2, which is precisely when I'm thinking that energy prices could be rebounding. I mean, energy prices are rebounding again now. They are rebounding now, but let's remember that economic time and market time is very different. Investors, they are very forward-looking. They are looking at a few.
They're going to try and anticipate it.
Exactly. While in terms of CPI and impact on prices, we need a couple of months of sustained increase in energy prices. And I think we'll get them with the Chinese reopening. And what was really interesting in Brainerd and Waller's Q&A is that both of them mentioned China's reopening and energy prices as a key risk to the inflation outlook. So maybe I'm not so far from the Fed.
Right. Yeah. The one thing I was going to say about the energy price just made me think about, obviously oil, gasoline, jet fuel is important. But natural gas prices have come down a lot. That's also gas, I'm assuming, is a fairly valuable component for consumers and corporations in the US, right?
Yeah, but in economic time, so over a couple of months, all those prices tend to be quite tightly correlated. And if you look at the energy component of the CPI, it's really well correlated with oil prices. It's not as high as market prices for crude, but it is fairly tightly correlated.
Yes, and also nat gas is like, it's like a Henry Hub price. Like what price people in New York have to pay for natural gas, the Northeast, can be completely different.
From European
so gasoline is kind of like, that's a fairly standard where there's a correlation between, could be $1.50 difference, but the correlation between prices in California and prices in Florida or Texas, it's probably pretty highly correlated. Now there may be a dollar difference, but if it's going higher across the country, it's going to be going higher in most states. Okay. Were you surprised by, sounds like no, were you surprised by any of the market reactions?
Well, I mean, what I thought was really interesting was the market reaction to Waller's speech. It was underreported. In fact, the amusing thing is Wall Street Journal coverage came up on their site 5 minutes after the speech itself was posted on the Fed website. So the Q&A was not reported at all. I mean, the way it works is that the Fed often gives the copy to reporters in advance, asking them to respect. So the Q&A, which is where all the interesting stuff was not reporting. And I was looking at the Bloomberg headlines, there was nothing. And in the Q&A, lo and behold, one of the people who was asking question managed to basically get Waller to hint that if inflation behaved as the market expected, there would be a good chance of cuts by the end of the year.
Oh,
I mean, he didn't use the word cut. I mean, you know, there is all this nice language codes that are
slightly less restrictive. If
we will change policy. I will be a happy man, and we will change. There will be a case for changing policy. So again,
so that's kind of a big deal. Yeah,
it is a big deal.
I think some people, like obviously hedge funds that where I'm sure they're seeing that. Yeah,
and definitely,
and maybe that's what pushed the markets up more on Friday.
Well, the market rallied after the speech, not a lot, because you need to have nerds like myself listening and talking to their colleagues. But yeah, I could see the news spreading next week and supporting a market rally, even though maybe this is a good segue until to what's coming next week. Or
perfect. Yeah, go for it. So yeah, let's dive in. I'm just looking at from your sheet that you shared with us, some interesting stuff next week. Definitely some interesting data points, in addition to a lot more corporate earnings coming out as well.
Definitely. So. And next week, I think we're going to have, there's a good chance we will have the regime I'm expecting more or less for the first quarter, maybe a bit beyond Goldilocks, where inflation is low, or we have negative inflation surprises and positive growth surprises.
Yeah.
And given the, what we've heard from Fed speakers, I don't think they are going to put too much. Anyway, next week is a blackout, so no speakers. But in this regime, given what the latest data prints have looked like, whether it's the things distorted by seasonality, in my view, like retail sales, seasonality is going to last. And also we are going to have a PC print of 30 basis points. I think we'll continue to hear
the PC. This is the thing that the main data point that the Fed follows.
Okay, correct? So there are two price indices in the US. One is the CPI, which is fixed rate. So like when prices go up, typically people tweak their consumption, they go for cheaper goods, or they consume more of the cheaper goods. So that's not picked up by the CPI. And the CPI also measures out-of-pocket cost for everything, so like healthcare. And the other one is the PC, which allows for some substitution. It's based on what people actually consume every month. So the weight change a little bit. And also it captures the cost of the consumer bundle to everybody. Like, for instance, medical cost, not just your out-of-pocket cost, but the cost to insurers, and so on and so forth. So the index that the Fed looks at more closely is the PC. The problem is the PC comes 2 weeks later than the CPI. So market is very focused on the CPI, also because that's the index on which the tips are based. But for the Fed, the PC is what they look at. So the consensus is 30 basis points, which seems reasonable to me. And as always, the question is going to be, the three components, core goods, rents and core services, excluding rents. Rents is very close in the CPI and in the PCs.
I was going to ask that. The
Yeah.
way PC looks at rents is similar to, so,
Yeah.
so
Yeah.
it took longer for it to go up, and it will take longer for it to go
Yeah.
down, even if prices went up much quicker, or prices are coming down much quicker.
Marginal prices adjust much faster than average prices because leases are typically set on a yearly or at most bi-yearly basis. So this one, I think the potential for surprise is quite low.
So what? So it's 0.3% month on month, and what's the annual? Do you know?
Gosh, I'll have to check on my
Okay, fine.
but
it's not that important, but just curious.
Yeah, no, people are really focused. I mean, the Fed is really focused on a month on month, obviously. They are hoping we are really at a turnaround point. Right. So that's the focus.
And you think for the Fed, what is that kind of like? They're gonna want to see consistently 0.2% month on month or lower for 3 or 4 months or something.
So again, in Waller's Q&A, which A is only Waller and B, it's not official. I mean, it's not as cast in stone as the speech itself. But in response to that very nice question by that lady who started to thank him for his great service at the Fed, and rightly so, but perhaps that made him more willing to give the information that he would have been better off not giving out. He said, well, we will look at how things stand until after the summer. So we're talking about maybe 9, 8, 9 more.
8 or 9 more.
Yeah.
Okay. All right. And then, what other big data points, I think?
Okay. So on that same day, we get personal income and spending. And for me, the important thing is household savings rate. It's really, last year we had an unbelievable fiscal consolidation. This year we have fiscal easing. Last year, what kept the economy going was a decline in the savings rate. Basically, people were spending the absurd stimulus of the Biden administration. Now the savings, must have been close to exhaustion. And so savings rates are going to recover, but I think not that fast and not too much. And I think it
you think savings rates are going up or down?
Up, but very gradually. And the reason for thinking they are going up is that before the pandemic, they were about 7-8% of disposable income. And then you had this gob of cash that was handed out by the Biden administration, which people have been spending, and which explains why.
So the savings rate was very high for all these reasons, and has been going down.
Exactly.
Especially because wages are not keeping up with inflation in general.
Definitely.
And then that trend should continue.
But I mean, we haven't even seen the beginning of that trend. All we've seen for the past couple of months is a stabilization of the savings rate. So it's going to, I think, to go up fairly gradually. But I think what's going to work in the opposite direction is that we have a recovery in real household income, excluding transfers. And that's a data I like because it gives you a sense of how sustaining the economy is. And of course,
it means the savings rate should be going back up because of that.
Yeah. It's going back up. And so that's the other variable I'll be looking at very closely. And then what is happening on January 1st, of course, is that indexed government transfers like pensions will go up by last year's CPI. So that is also going to give a boost to demand. But so that's Friday. This data to me is important in terms of what it says for the economy going forward. The day before, on Thursday, we get Q4, the first estimate of Q4 GDP. And I've been banging my drum on this, that, the market initial forecast was 1%. Now we are at 2.6%. Yeah, probably I still see a scope for a positive surprise, but, even if it's only 2.6%, that is definitely not what the Fed wants, the more thoughtful.
That's not the below trend growth.
Yeah, exactly. So other than that,
PMIs, what else?
well, the trade balance, nothing much going on in terms of this month's data point. It's improving, and it's interesting to see why it's improving. There is a big increase in exports of chemicals because a number of European manufacturers have actually moved to the US, because for chemicals, the key ingredient is energy. And, that is one of the long-term structural advantages of the US relative to other countries. They have good access to energy supply. So we've had, a big rebound in the trade balance, and I think it will continue. Otherwise, we will get, the PMIs that are likely to be as gloomy, manufacturing PMIs, from S&P, the Richmond Fed, the Kansas City Fed. But as I have explained before, the goods sector of the economy is being hit by a double whammy. The dollar, biggest, strongest, fastest, meanest real appreciation since the mid-1980s. And then you had to move from goods to services consumption. But I think in terms of the dollar, the worst is behind us. The peak is behind us.
Right. Yes.
One of our
last 5 weeks or something. Okay.
Yeah. One of our core views is that the dollar is going to weaken from here. So I would take weaknesses there as a sort of a legacy of those shocks. And then we get, jobless claims as
can't rally, can't go up.
Well, what can I say? The decline this week was probably exaggerated by distorted seasonality. But just to give you an example of how biased the whole media consensus is, the Wall Street Journal today has an article saying that the duration of unemployment is increasing, and citing the case of 2 people. And this is factually wrong. When I saw this, I rushed to my Bloomberg terminal. And if you look at the median or the mean of employment duration, it is the same or below before the pandemic, and it's not going up. So sticking to facts, that's what I intend to do. And then we have durable goods orders. The problem is that it's about December, so it will already be incorporated in the CapEx data in the Q4 GDP, but we'll get a sense of what the time profile looks like, and who knows, we might get some information on where things are headed. But the Atlanta Fed nowcast expects a recovery in CapEx. And when do firms, which is extraordinary given everything the Fed has been telling us about high interest rates constraining corporate demand. Corporate demand is not going down, it's going up. Look at the unemployment growth and CapEx. And when do firms invest? They invest when they've run out of capacity, typically. So rebound in CapEx in Q4 to me suggests that there is more upside to growth.
And then on political developments, obviously this whole debt ceiling kind of drama. I think, as we discussed last week, it doesn't have to be dealt with. There's a few months now. What's your take on it?
So to me, it's like the nuclear war, mutually assured destruction. And in fact, one of my favorite books was written about this Cold War brinkmanship, the strategy of conflict. And basically, because of this mutually assured destruction, both parties are going to settle, but there is a whole range of strategies they can use to try the best possible bargains. And one of the strategies is to convince your opponent that you are crazy. Say it's Kim Jong-un and his, in North Korea and his nuclear brinkmanship. So if the Republicans could convince the Democrats that they don't care about the US defaulting, they will not budge unless
right, especially this fringe group which he had to make a deal with,
The problem is that for them, from their perspective, is that last week Senate Minority Leader McConnell said there will not be a US default. So that's undermining the bargaining position of the Republicans. But
I think I also saw that Trump also was saying, don't touch Social Security and Medicare, I think.
Trump is a spent force, hopefully. But, on the Democrat side, the same thing happened, because initially the position of the White House was, we're not interested in discussing this. We don't see why Congress should not pay for the expenditures it decided to make. But on Friday, House Speaker McCarthy announced that he had been invited by President Biden to the White House to talk about raising the debt ceiling. So, on either side, there is already a bit of a softening of the bargaining position. And I mean, the end result is the same, just like, we've avoided a nuclear war so far. By touch wood, we avoided a default. I mean, defaults are not vote winners. And that's why.
Are there parts of the, I guess, the budget that was agreed that you think that they could touch or maybe even should touch?
So I will not comment on the specific expenditures I would like to see cut, because that reflects my preferences as a voter more than and our listeners don't necessarily want to know about that. So I'll just speak of it in macro terms. I mean, budget deficit is crazy. In cyclically adjusted terms, the IMF expects it to increase this fiscal year, and it's just going to make the Fed work more difficult. In fact, this loose fiscal policy is one of the reasons I'm so bullish on growth.
Right. It's a great point. Okay, awesome. Anything else? I can kind of quickly dive into some of the stuff we released over the last week.
No, that's the gist of it, I think.
Okay. Well, by the way, thank you, and another awesome week. We always get such good feedback from clients on everything you do. I mean, like, even meet clients in
I
person.
love Macro Hive. This is my best home ever. That's
awesome. We feel the same. Okay, so quickly, for our pro clients, for some of the things definitely worth checking out if you haven't, is Bilal's kind of latest macroscope, which is kind of a lot. I know you guys have been discussing how and why oil can hit $120. And obviously a lot of it is around the China reopening and all that demand coming back, plus obviously the trying to reinvigorate the property sector there, and then goes with all the lack of investment, energy sector, and everything else that goes along, other political things. But that would obviously have a big impact on inflation, as we discussed. Another one was the rates weeklies, where Bilal was kind of looking into, which I thought was I actually asked a similar kind of question. And he said, I'm writing a piece on this, how much lower can kind of short end rates go in the US with all these cuts that are priced in. And this was off the back of one of our pro clients asking the question, and we're kind of debating about like that it's crazy that this much is priced in, and he was kind of just took a point in time on the curve and looking about kind of comparing that to where inflation is expected to be, even with the Fed's point, and how if you just use the facts of where the market is currently pricing cuts at that point and what even the Fed is assuming inflation, those two things are very hard to kind of assume would take place at the same time. So that's a super cool piece. And for our very cool. I'm sure you guys discuss it a lot. For our prime users, the dot, something you were just referencing, the dollar endgame has begun. And why? And this was obviously after a massive rally, even with the dollar on most metrics being viewed as long-term, significantly overvalued. Now, for many reasons, we're viewing that that will be unwound. And this is probably just the beginning. And that's our view in our moderate portfolio versus a lot of the major currencies, and also certainly versus emerging markets as well. The couple of pieces on crypto, both of them kind of neutral to bullish. The crypto indices, surprisingly, how the markets hung in there despite this Genesis announcing bankruptcy. And I thought particularly interesting was I'm going to say this is the first time in a year, on-chain metrics that we follow. So we look at a whole bunch of factors of fundamentals specific on crypto, and then macro factors, and forget about even the stuff we're talking about, which would also probably begin to get much more supportive on the macro. On-chain metrics for Ethereum is starting to go from kind of neutral to bearish to very bullish. And I'm pretty sure it's the first time at least a year. So that's very interesting thing. And Richard Jones wrote a very cool piece on the US housing market, where we think that that's heading, what the risks are, and that this is probably like a long-term trend. By the way, other Bloomberg had a piece, I think maybe even more commercial, but kind of the beginning to be struggles in the commercial property sector, and for people who are not always experts on everything around the housing market, obviously the 07-08 crisis really, came about and driven by the problems in the housing market, but house prices themselves really didn't bottom until I think even like 2010 in many cases. So it's not an immediate thing. It takes a long term to play out, as you were kind of, that's just in general buying, but also obviously on the rental side for the reason that you gave. That's kind of it from my side, except for, thank you. Hope everyone's off to a great start for the year. Hopefully everyone is enjoying the warm weather and sunshine in my background as much as I am, despite the winter sweater. And and have a great week. And obviously, as always, please reach out, any feedback, everything we'd love to hear.
Absolutely. So good luck, everybody. And hopefully we'll talk again next week.